Hi, I wanted to talk a bit today about the Federal Reserve and sound money, but I wanted to come at it from a slightly different angle than we normally talk about it. I wanted to start by talking about stocks and bonds, and I know to a lot of people, stocks and bonds sound like wagering on ponies for wealthy people. But the truth is, the stock market and the bond market really touches all of us. A lot of us have 401k plans, retirement investment plans, pension funds. Um, we've heard a lot about that in Kentucky with the teachers' pension funds the last few years, which is another aspect to remember is even if you don't have any of those things, as one of my fellow taxpayers, you could be on the hook with me for bailing out the program if it's not getting the returns they anticipated, which has been largely happening for about the last decade. And the reasons why are part of the point to this talk today. And another point I wanted to raise is we think about investors, and more to the point, I guess we don't think about investors. They're just these nebulous people out there who are gobbling up profit at our expense. And the truth is, they actually serve a purpose. Investors, ideally, this has been a little less true as of late, but ideally, investors are digging into companies. They're finding out if their culture's right. They're finding out why they work well, or possibly why they will work well, to invest in somebody in the future. So an example is Netflix. 2 decades ago, Netflix didn't exist. And not so long ago, I guess it was around 2012, I remember their stock was down like $60 a share or something like that. I should have bought. I didn't. I knew better. I didn't. But, now a lot of us are watching Netflix while we're safe at home. But they've made a lot of these shows off of selling bonds. So it's kind of crazy. Your pension plan might have bought bonds off of Netflix, and that paid for the show you're watching while you're not at work. But there's kind of a problem I wanted to point out, and I wanted to point it out just using Warren Buffett's company, Berkshire Hathaway, just as an example. Right now, they have over $370 billion on the sidelines. That's over 1% of the stock market on the sidelines, just waiting to be invested in the next Netflix or the new whatever, maybe the thing that's going to replace Kroger. I don't know. But whatever it is, they're not finding it, or they haven't found it yet. And a lot of where Warren Buffett's name recognition comes from is his aggressive investing in the downturn in 2008. He's one of those people where when everybody else runs away, he's swooping in. So the fact he's not swooped in my mind, tells us something. Now, it's just a random example. It could be he's off his game. I don't know. Maybe he's gotten paranoid. I don't know. But I think the problem comes from the Federal Reserve being so heavy-handed. They're working to push up market prices. It's not their stated goal, but in effect, that's what their actions do. And it leaves investors able to just invest in anyone, because there's so much money being pushed into the stock market that it's no longer a matter of you need to pick the right company to invest in. You need to pick the smart company to invest in, or the company with the corporate culture that's going to work in today's world. What you really need to do is you need to just invest in companies in front of the Fed inflating the market. And they don't buy stocks, but what they do is they buy up the low risk assets. They've, traditionally treasuries, but in times like this, they're buying munis, either as of yesterday or today. They're buying bonds, not directly, but to simplify things, we'll just say they're buying bonds. Well, that means they're competing against your pension fund. So all of a sudden, anyone selling bonds are going to be able to sell bonds a little bit cheaper, which means if you're a teacher, your pension fund's in not quite as good a shape as it was a couple of months ago. Or even if it is, it's not going to be over the next decade, because we just saw what happened when you have to pump this much money into the economy. You don't get to just remove it. We had barely removed maybe a third of it between 2016 and 2020 when this happened, and now we've already pumped in more than we removed. So this is going to be probably a very long time that savers are suffering from this. So where does this come from? Well, where this comes from is it comes from the dual mandate of the Federal Reserve. Not only is the Federal Reserve supposed to keep stable prices, or as I like to think of it, keep the value of the dollar stable, but they're also supposed to maximize unemployment. Did I say unemployment? They're supposed to maximize employment. Sorry, I don't know which way I said it. I got distracted. And I realize the second one sounds really, really good. That's been around since like 1977. And, the idea of the Fed having multiple objectives dates back even before that, because, they're this huge, massive sledgehammer, and you feel like you could do a lot of work with them. But the problem is, as soon as you start compromising that idea of keeping the dollar's value sound, you start risking trouble. And not only that, but where you're trying to do good, you also risk doing harm. So an example of that is right now the removing pain from the stock market. And I understand it. I empathize with it. I mean, I do okay. I'm not rich, but I've got a little retirement thing set aside, and yeah, in March it did not look pretty. But you know what? That pain's actually good, even when it's my pain. And the reason it's good is we want investors to be cautious. We want investors to invest wisely. There's a point to people like Warren Buffett. There's a benefit to people like Warren Buffett. We want, for the most part, Warren Buffett's digging in and figuring out which companies to invest in. We really don't want just a lot of people going, bonds have no returns, I'll just shove the money over here, which is what's happening these days with the stock market. And it means that even companies that really shouldn't get invested in, and anyone who looked closely at them would realize they shouldn't get invested in, yeah, they still get invested in. And what we really want is we want efficient allocation of capital. So also, again, I mentioned the bonds. So all this random investing also comes at the cost of bondholders, which maybe you don't think you know any bondholders, but if you know a teacher, you know a bondholder. If you know anyone on a state pension plan, you know a bondholder. They might not hold the bond directly, but the returns of the bonds are a significant portion. Also, the returns of the munis is a significant portion of how their retirement's going to work. And all these shortfalls that we're hearing about, not all of it, but some of it is from the fact that bonds don't pay what they used to. Why? Because the Federal Reserve put the interest rate on the floor, and then additionally started buying bonds and competing directly in the bond market. And another problem with this is I view it as painkiller. If you've heard me talk, I'll talk about painkiller a lot. And the problem with painkiller is painkiller keeps you from identifying the actual source of the pain. So you end up not solving the underlying problems. So we haven't done anything to make our infrastructure more efficient. We've done very, very little to make ourselves more competitive globally. Our education system hasn't really improved. I mean, I'm all for maximum employment, but maximum employment should come from us being effective in offering things to one another and offering things to the world at large, not just because we're trying to pump a lot of money into the market. If that's the only thing that keeps us employed, then all we have to do, or all we can do, is just keep pumping more money into the market. And that pretty much is the definition of addiction, isn't it? You're not really able to function any longer without it. All you can do is keep pumping it in. So this is why I think you should put me in Congress, is I'm willing to face that pain. I'm willing to talk about that pain. I would love to work to end the dual mandate. For that matter, I would like to move us back to a sound monetary system instead of a fiat currency. And either or both of those would create a lot of short-term pain. But ultimately, the question is going to be, are we strong enough to deal with reality? Or do we want to stay on the monetary equivalent of opioids until we find ourselves at the bottom of the proverbial dumpster? Because I don't know how many decades this is going to take, but ultimately, that's where this leads. Read your history. That's always where this leads. And part of the effects of it we're seeing right now. So I know that's not an upbeat message, but sometimes it's just about communicating who you are. So now you know a little more about who I am. If you have any questions, send them to me. I will talk about anything you want me to talk about. Great. Have a great day.